Hello folks, I'm Rodney Hathaway, Chief Investment Officer at Waukesha State Bank Wealth Management, and welcome to our June edition of Market Chats. One of the most important questions in today's market is whether productivity is improving and what that means going forward. Productivity or output per hour worked has shown encouraging signs. Over the past 3 years, it has grown at about 2.7% annually compared to a long-term average closer to 2.1%. In simple terms, the economy is producing more with fewer workers, which is helping efficiency improvements. There's also growing optimism around technology, especially artificial intelligence, as a potential driver of even greater efficiency. If that continues, we could see stronger growth without the same level of inflation pressure we typically expect. That's important because most economic cycles, fast growth leads to higher inflation and rising interest rates. But when growth is driven by productivity, by doing more with less, it can allow the economy to expand in a healthier, more sustainable way. What this means for your portfolio. First, it reinforces the importance of owning companies that are becoming more efficient. Businesses that are using technology and innovation to improve how they operate are often better positioned to grow and stay competitive over time. Second, if productivity helps keep inflation in check, it creates a more supportive environment for bonds. That means there may be opportunities to lock in today's interest rates for longer-term income and stability. Third, this type of environment can support growth without the usual overheating risks. That's generally positive for long-term investors, but since it's still early, it's important to stay diversified and avoid relying on any single outcome. And finally, not all companies will benefit equally. Some will adapt and thrive, while others may fall behind, which makes careful investment selection more important than ever. Bottom line, there is encouraging evidence that productivity is improving, but it's still early. If this trend continues, it creates a powerful combination of steady economic growth, manageable inflation, and a more supportive environment for both stocks and bonds. For now, the best approach is to lean into those long-term opportunities while staying balanced and disciplined. Thank you for tuning in. Please reach out to one of our advisors if you would like to discuss this topic further, and we will look forward to our chat with you next month.